the title of today's lecture, I think we're calling it, is what determines stock returns. However, if you've come along because you think I'm going to tell you the answer, I'm afraid you are mistaken, all right? What I am going to do, however, is to try and look at some theories that relate to stock returns, to also link those ideas with some of the material that are in our finance modules, so some of the modules you might be studying depending on which particular program you're in, and I guess which particular stage within that program. And the other thing I want to do briefly is to look at some of the literature in this area, particularly the empirical literature where people have made use of these theories. So that's roughly what I'm hoping to do today. You've all got a handout, I assume. Has handout gone around to everybody? I take it that's a yes. Right, so a handout of my slides. And where do we start? Well, let's start with a little bit of theory. We will in a minute. Okay. What I've done is labelled this two extremes. So in terms of theoretical ideas, one perspective and one completely different perspective. And inevitably most are actually in the middle there somewhere. But I thought this was a reasonable place to actually start. So at one extreme we have what we might call the rational approach there. Notion that in some sense shares, stocks have an intrinsic or true value, as you can see. And here's my attempt to sum up in a little phrase what we have in mind within that context. So the notion would be, as you can see, that the value of a company is determined by the present value. And that's very important. The present value of the cash flows or earnings that will be received. And again in brackets there, a notion of free cash flow perhaps. So important in terms of taking things forward is the notion that we're talking about present value, but present value of future cash flows, perhaps future free cash flows. So cash flows that are not, no, let's do that again. Cash flows which are not used elsewhere. So they are in a sense free. At the other extreme, and again a little phrase to try and sum this up, we have the notion that share prices, stock prices are completely volatile. So demand and supply move around all the time, and hence share prices, stock prices fluctuate all the time. And we can think of that in terms of various notions, as you can see, anticipation, hunches, and so on. A phrase of a very famous economist from about, 70, 80 years ago, I guess, was this notion of animal spirits. And that was someone called John Maynard Keynes. But the general notion is unpredictable, completely unpredictable, random, all over the place. So at one end, we have what we might call a kind of rational approach. At the other end, we might have what we could call an irrational approach. Continual fluctuations and no settling down to any notion of intrinsic value. And what I want to do, probably for most of today, is to focus on that notion of the rational approach. Though I will allude as we go along to some elements that I guess we'd call the irrational. One thing to think about at this stage, and I'll come back to it if I've got time, is how new information could impact on both of these. So if we have new information related to the company, that may well affect our assessment of future cash flows, of future earnings. And that could, taking our definition here, have an impact on the value of the firm, hence an impact on the share price, or the stock price. Similarly, within this notion here, are irrational. Again, new information could lead to the speculation, more anticipation, and so on. So again, it could be impacting on demand forces and hence having an impact on price. And I guess in this latter context, we might want to ask, well, is this information actually accurate? Or is it inaccurate? Given it's all based, the suggestion is, on anticipation, hunches, and so on. But as I say, where I want to start in terms of theoretical ideas is to focus more on the first of those. And as you can see, we're talking about present value of future cash flows. So let's take this present value notion first. That's a notion which sometimes people refer to as discounting, because we're looking into the future. The other phrase that's frequently used is the time value of money. And what I've got here is a little illustration of what we mean by that notion of discounting or the time value of money. Hopefully, the little illustration works. So, think about the notion of having something now. Nice easy numbers, so let's suggest $100. If we have that $100 now, it's worth $100. And one way of thinking about that, as I've got on the slide, is we've got it, we can go to the shop downstairs and spend it. So clearly $100 is worth $100. But if we think about a year's time, or indeed 2 years' time, or 3 years' time, so some time in the future, then the value of a figure in the future is not the same as the value now. And particularly, as you can see there, it will depend on, well, I've said the interest rate, it will depend on an interest rate. And again, some of what I want to say today is about the appropriate interest rate. Again, let's take some simple numbers. So let's say this interest rate in question is 10%. If that's the case, then the value of $110 in a year's time is actually only $100 now. Because in principle, even though we haven't got our hands on it, in principle, that $100 could be invested for a year, and that would have given us $110 in a year's time. So the value now, the present value, is less than that future value, with how much less depending upon the interest rate. So let's just see what we've done there and see if we can establish some sort of general principles from this. So we've said a year and we said 10% to keep the numbers, fairly simple. So what we're saying is if we took our $100, we invested it for a year at 10%, we get $110. So in terms of a little calculation, we've got our $100 now times 1, that's our $100. Plus $100 times our 10%, so times 0.1, and that's the extra $10 we get. Put the two together, 1 plus 0.1, and again, this is quite often the way in which you'll see, interest rate calculations presented. So there were a few little figures to illustrate, but let's begin to draw out the principles from that illustration. So what we've said is the present value times our interest rate, or 1 plus our interest rate, is equal to our future value. Hence a bit of shorthand to represent the interest rate, I, PV representing present value, and FV representing future value. And we can also be a bit more explicit here in terms of our time dimension. So usually when we're talking about now, we label that with the subscript 0. What we're talking at the moment is about one time period into the future. And the simplest example is we had, 1 year. So the future value in 1 year's time. And we're multiplying by our interest rate, or 1 plus our interest rate. And we're only talking about one time period. So the 1 also appears there. Moving a little bit towards our definition of intrinsic value. Let's rearrange that a little bit so that we focus on this idea of our present value. And as you can see, all we're talking about there is taking our interest rate figure over to the other side. So we isolate our present value, we can get an indication of what our cash flows or our set of future values are actually worth now. Now that's 1 year ahead. Let's think about the same principle if we're talking about 2 years ahead. So 2 years into the future. Again, let's keep our figure simple. So let's think about what the future value would be if the present value was $100 and we were looking 2 time periods ahead. In a year's time, we'd have 110, as we've already seen. We then multiply by 1.1 again, and that gives us 121. So the present value of $121 in 2 years' time would be $100 now. And think about what we've done there. We've taken our first interest rate, or interest rate for the first year, so multiplied by 1.1, and then we've multiplied by 1.1 again, because we're talking about 2 years into the future. So what we've done is multiplied by 1.1 squared. Squared because we are 2 years into the future. And again, principles here when we consider the notion of our present value. So now we're thinking 2 years ahead. Hence we have 1 plus the interest rate squared. And that gives us our future value in 2 years' time. And again, we can rearrange so we get an indication of the present value, what we're actually interested in at the moment. The present value, the value now of something which is received in 2 years' time. But if we go back to our definition, that notion of intrinsic or true value, then what was being suggested was not just 1 year ahead, not just 2 years ahead, but 3, 4, 5, 6, 7, in principle at least, indefinitely into the future. So what we're talking about is our future value 1 year, 2 years, 3 years, 4 years, and so on into the future. And hence, if we think about what we've actually done so far, our present value, the value now,